If you're serious about property investing in 2025, the game has changed. The days of buying anything and watching it double in value, they're a little bit over. Cash flow is absolutely king again. But building a true cash flow positive portfolio, it takes a bit of strategy, not luck. G'day, I'm Alex Watson from Funded Finance, and today I'm going to break down exactly how to build a cash flow positive portfolio in the current market by understanding lending shifts, using real data and rent yields and regional trends, and most importantly, structuring your portfolio for steady income, not for hyper-driven inflation growth. Let's start with where we're at. Interest rates, they've stabilized after a few volatile years, but they're still sitting higher than the ultra low levels we saw during the boom. And that means borrowing capacity, it has tightened. Investors are under more scrutiny and yields matter more than ever. The key difference between 21 and 25 is that investors now have to prove their numbers stack up. It's not just a hope for capital growth. Lenders are stress testing your income and your rental returns more aggressively. So understanding how those numbers interact is critical. If your portfolio isn't cash flow positive or at least neutral, every interest rate rise eats into your buffer and limits your next purchase. And that's why we're seeing the smart investors, the ones still expanding, shift their focus from buying for emotion to buying for outcome. Now let's talk lending, because this is where most investors lose ground without even realizing it. In 2025, lenders are looking more closely at your total debt exposure and the cash flow of each property individually. If one property is heavily negative, it can drag down your borrowing capacity across the entire portfolio. So how do we navigate this? First, we structure your loans correctly. Avoid cross-collateralizing properties. Keep each loan separate so one property's performance doesn't limit another. And that flexibility is what allows you to refinance, release equity, and keep growing without being handcuffed to one bank. Second, look at loan features that directly support cash flow. That means offset accounts, split facilities, and reviewing your rates regularly. And third, always build a buffer. Even a portfolio that's technically cash flow positive on paper can fall apart if you haven't set aside at least a couple of months of repayments per property. And I see this mistake constantly. Investors running on razor-thin margins, then scrambling when a tenant moves out or repairs come up. So let's move on to a few of the numbers that really determine cash flow. Interest rates are the single biggest cost on your portfolio. So if your rate starts with a 5 or a 6, it's time to review. Even a 0.05 difference can change your weekly cash flow by hundreds of dollars per month across multiple property. Rent yields, on the other hand, are your income engine. In most metro markets, yields are still sitting around 3 to 4%. That's not enough to offset high interest costs unless you've got significant equity or a large deposit. But when you start looking beyond the capital gains into high demand regional or satellite areas, you'll often find yields closer to 5 or 6%, sometimes even higher. If you combine that with steady population growth, strong rental demand, and infrastructure investment, suddenly you're in a much better position to generate positive cash flow and growth potential. And I'm not talking about chasing cheap properties in tiny towns. I'm talking about identifying regional hubs with diverse economies, areas with hospitals, university, logistics, or even defense deployment and employment. That's where consistent rental demand supports sustainable cash flow. A cash flow positive portfolio isn't built overnight. It definitely isn't built on social media hype. Your goal is predictable income. That means every purchase needs to meet two criteria. It must perform now and it must support your future borrowing power. Start by identifying properties that deliver a solid rental yield from day one, not ones that might do well if the market goes up. Use conservative assumptions like vacancy periods, rising maintenance costs, then layer in a long-term view. Will this property attract stable tenants? Is there ongoing demand for the type of dwelling you're buying? One powerful way to lift cash flow without compromising quality is through small tweaks. Things like adding a secondary dwelling, improving energy efficiency to lower tenant costs, or negotiating rent reviews in line with inflation. These micro strategies can make a big difference over time. And also, don't understand the impact of good property management. A 1-week vacancy can wipe out a month's worth of profit. Work with your professionals who understand investor returns, not just tenant placement. Once you've secured your first or second positive cash flow property, it's time to think like a portfolio manager. The order you buy in matters. Start with properties that balance yield and growth. These act as your cash flow anchors. Once your income foundation is solid, you can strategically add assets that lean more towards capital appreciation. And that balance is what allows investors to keep expanding without hitting a financial wall. And remember, each property should have a clear purpose. Some are there to generate income. Some are there to unlock equity. Mixing the two too early can slow your progress dramatically. And this is why reviewing your numbers every 6 to 12 months is crucial. Lenders' policies change, rents moves, and interest rates shift. Staying proactive is what keeps you ahead of the curve. Finally, let's talk mindset. The most successful investors I work with treat their portfolio like a business. They track income and expenses, review performance regularly, make decisions based on data, not emotion, and keep an eye on the next opportunity. Understand that property isn't just about owning real estate, it's about managing cash flow, mitigating risks, and reinvesting profits strategically. If you're still thinking of your properties as passive, well, you'll always be limited by what the market gives you. But when you start operating like a business owner, forecasting maintenance and optimizing, you can take control of your financial outcomes. So if your goal for 2025 is to build a portfolio that pays you, not one that drains you, focus on strategy, structure, and sustainability. Understanding how lending works today, target the right regions with genuine rental demand, and make sure every decision supports your long-term cash flow position. If you want to see what your numbers actually look like, book a strategy review with me and my team at Funded Finance. We'll show you exactly how to structure your loans, optimize your yields, and build a portfolio that actually performs, not just in theory, but in the real world. I'm Alex Watson from Funded Finance, and I will see you in the next one.